Welcome to Level 4 Lesson 2. My name is RIA the Trader from TradingWing.net. In the last lesson, you learned about technical indicators. In this lesson, you will learn about the main types of market indicators used by traders and investors on a day-to-day basis. So let's get started. The first type of market indicator is known as the advance decline line, better known as the AD line. I briefly mentioned its existence in the previous level, but let's go ahead and break down what the AD line is. The AD line plots the difference between the number of advancing and the number of declining stocks on a day-to-day basis. Its main purpose is to identify the overall market sentiment. However, what's great about the AD line is that it can also be used to find divergences. One thing to note down with the AD line is that it is a cumulative indicator. Let's have a look at an example of what that means. Let's say today there are 20 stocks advancing and 18 stocks are declining. This means that 2 points will be added to the overall AD line. This is because there are 2 more stocks advancing than there are declining. If there were 20 declining stocks and 18 advancing stocks, 2 points would be subtracted from the AD line. This is on a day-to-day basis. Let's have a look at what the AD line looks like on a chart. Once you have gone ahead and added the advance decline line indicator to your chart, you should see something that looks like this. It is drawn on a single line and changes on a day-to-day basis due to the AD line calculation that we mentioned earlier. Let's look at an example. On this day, January 12th, 2022, the AD score was 1070. On the following day, however, being January 13th, the score was 1068. This means that overall, on the following day, there were 2 more stocks declining than there were advancing. As I mentioned, this is cumulative, so it does not reset on a day-to-day basis, but rather continues where it left off. Now, as I mentioned, AD lines can be used to identify divergences as well, similarly to the RSI. So let's have a look here. We can see that we have identified one high and identified our higher high. On the AD line, however, the opposite is true. We have found a high, but found a lower high. This is a divergence that is essentially informing us that the market will change direction. And it does exactly that. The next type of market indicators are known as moving averages. Their main purpose is to provide the average price based on your selected number of candles. They are, however, known as lagging indicators, as they are 1 candle behind at all times. There are 2 main types of moving averages. The first being the simple moving averages, better known as SMA or MA. They are calculated by measuring the average price of the number of candles you asked it to. For example, if you were to state SMA 14, it would look at the average price based on the previous 14 candles, not including the current candle. The exponential moving average, better known as the EMA, does the exact same thing. The only difference here is that the EMA adds more weight to more recent prices, as they are more representative of the stock. Let's have a look at an example of both. On this chart, I have gone ahead and plotted the simple moving average of 50 as well as the exponential moving average of 50. Both indicators are calculating the previous 50 candles. However, The EMA 50, or exponential moving average of 50, is also taking into account the added weight of the more recent candles. That is the blue line on the screen. You can see how the blue line is lower than the green line because the more recent candles are moving downwards. That is proof that the EMA is adding more weight to the more recent candles and not simply calculating the average. The final type of market indicator is known as on-balance volume, better known as OBV. OBV works similarly to the AD line, as it is also a cumulative indicator. However, the OBV uses volume instead of looking at advancing stocks and declining stocks. This means that the OBV focuses on the singular stock or security instead of the overall market, as the AD line does. What's important to note down here is that the OBV looks at the difference in price or the change in price on a day-to-day basis to determine if it is going to add the volume to its value or subtract volume from its value. This may not make sense, but let's have a look at an example. Let's say on day number 1, the price of a stock was $1 and the shares traded was 200,000. The OBV value would be 0 as there is no previous day to compare to. On day number 2, the price increased to $1.10. This automatically means that we would add whatever volume there was that day to the OBV. Even if the volume is lower, we would still add it because the price increased in comparison to the previous day. Let's have a look at day number 3. The price increased in comparison to day number 2. We know that we will add the volume to the OBV indicator. The volume on day number 3 was 340,000, so we would add 340,000 to our OBV. This is where it gets important. On day number 4, the price decreased in comparison to day number 3 as we closed at $1.15. Despite the volume being greater than day number 3, we would still subtract day number 4's volume from the OBV, meaning we would subtract 400,000 from the OBV value. Let's have a look at how the OBV looks on a chart. After adding the OBV indicator to your chart, it should look something like this. Let's have a look at how we can apply this to the actual stock that we are looking at. On this day, the price closed higher than it did on the previous day, despite the volume being lower. That means we would still add to the OBV value because the price was higher than the previous day. On the next day, the volume was lower than this day over here, but the price closed higher than the previous day. This again means that we would add to our OBV value. Make sense? And that concludes this lesson.